Hi again, everybody. This is Kevin Pierce with Caldez Financial. We're here with Robyn Barret again. We're continuing our discussion. This is part 2 of accounts receivable financing. Thank you for joining us. And Robyn, let's get right back into it.
Great.
Not every receivable is a lendable receivable or a purchasable receivable. So in the case of ABL and factoring, I'm going to take a guess based on my experience that the what we call the ineligibles, or those that are not able to be financed, are pretty much the same from between a factor and an ABL, or are there differences?
I think there's differences, and this is again kind of where the products differ. I'm going to tell you where they're the same.
Okay.
So invoices over 90 days.
Right.
Ineligible across the board, no matter what kind of lender you are, right? Foreign receivables. Mm-hmm. I'm going to say that with a little asterisk because we again, ABL lenders and factors are incredibly innovative.
Right.
And I will look at a deal and I'll say, okay, I'll give you, if you've got, 10,000 of invoices, you can have 300 in foreign receivables. So sometimes we'll advance up to 30%. So we'll make some accommodations. Again, every deal, Kevin, as you know, is different.
Right.
And you have to look at a deal at the whole, right? And then see where you can kind of give and take to make sure your client gets the most availability. So let's just say foreign is off right now.
Okay.
Now here's an interesting one that most banks consider ineligible, which most factors, maybe not ABL lenders, will make eligible. Government receivables.
Okay.
Because factors can go ahead and get the assignment of claims.
Right.
It's very labor intensive. Banks don't like to do it. ABL lenders don't. Factors will do it.
Right.
So concentration, that's where there's a little bit of a split. Now we're going to talk about where things kind of split. ABL lenders, because it's more formula driven, are really going to be pretty rigid on concentration. Concentration for customers, maybe concentration for geographic areas. I mean, there's all kinds of ways that concentration could come in play. Factors will do 100% concentration deals.
Right, because factors don't care about, so there's two different kinds of risk when you're talking about concentration. One is payment risk, the fact that you're lending, you've got a concentrated, loan that's reliant on the payment from one entity or a small number of entities that have a large concentration. And the possibility that one of them may file a bankruptcy or something like that could damage the company, and that's why that's the payment risk. But there's also a business risk.
Correct.
And that is if an ABL customer loses a major loses a major account debtor, then not only is there payment risk there, but there's also go forward business risk, because that impacts their sales going forward and their ability to generate profit or cash flow, and that is sort of a double whammy. But in the case of the factor, you're not necessarily concerned about the business risk, really just the payment risk.
Correct.
So long as their account, as their credit is, worthy and you're okay with buying it. So if it's Walmart and this company sells 100% to Walmart, you can still buy that receivable, because if they lose that customer, you're still going to get paid on the receivable that you bought.
I'll collect out. Unfortunately, my client might not be okay, but I collect out.
Right.
Another ineligible, which is, again, this is going to be across the board, contra.
Right.
And so contra means that if I'm selling to you, you also sell to me.
Right.
So you're on my accounts receivable and my accounts payable. It's really a wash.
Right.
So the contra is not eligible. And
some industries, I guess in my experience, I see that in industries like aviation, where you're an FBO and you're repairing airplanes for an airline. Well, that airline also has FBOs, and they may, they may work on some of your equipment or something. So a customer is also, a customer is also a payor, and vice versa.
So those are pretty much a wash. Now I'm going to say again, there's the asterisk. We have had clients where we've worked with them where there has been a contra account, but maybe the contra, it's like I'm selling so much more to you than I'm buying from you.
Right.
What it does is it adds extra complexity. So, and again, ABL lenders, as you're kind of going up the whole lending spectrum, as you're going from factor ABL lender to bank, there's less administration on it. So at a bank level, they're just gonna be like, there's just no contra because we don't have time to figure out what's going on. you go down, so factors will have time, and that's where, again, our whole job is to try to find as much availability as possible for our client. So we will sometimes look at that and say, all right, we'll monitor the contra, and we'll fund against the contra as long as we can verify what the payable is, once a month or whatever.
Okay.
And then the last one I think would be related entity. So, you own a company, and then you own half of another company that you're selling to.
Right.
We just don't like to do. Nobody likes to do related
Right.
entities. There's too much that you don't see behind the scenes.
Right. Yeah, I mean, you have control over the payment. So if you're having trouble in the related entity and you're just not going to pay the bill, so it's not a good credit risk for the lender.
No.
Okay, terrific. All right, Robyn, we've talked about a lot of detail when it comes to factoring in ABL. Let's dig a little deeper. So I've heard terms describing different factoring arrangements, recourse versus non-recourse, personal guarantees. Describe how recourse works versus non-recourse factoring deals, if you would.
Great. Again, this is all about structure, right? In a perfect world, the lender's going to say, this is the structure I want, and then the borrower comes back, no, I want this. Things that can be negotiated and can't be negotiated. On the recourse and non-recourse, that's pretty much, you're going to go to a lender that's either 100% recourse, 100% non-recourse. So recourse means that if I lend on an invoice, and for some reason the debtor doesn't pay, whether it's because the goods were returned or the debtor went out of business, for whatever reason that invoice doesn't pay, I have recourse to be paid from your company.
Okay.
So, and the way the recourse can be, so let's assume that an invoice doesn't get paid.
Right.
I'm going to call you up and I'm going to say, hey Kevin, that invoice didn't pay. So we've got 3 ways we can handle this.
Okay.
One, you can send me a new invoice and I'll replace that. The second is I have reserves. Now, remember when we talked about how the factoring process worked and I'm only giving you 80% on day one?
Right.
And then when I collect the funds, I've got that $180. That $180, when we collect that, goes into what we call a reserve account.
Okay.
That reserve account is released to you. We release once a week. Most factors release once a week.
Okay.
But let's assume that invoice is not, we've got an invoice that isn't good. I can say to you, hey Kevin, you've got enough money in your reserve account, we can charge it back to your reserve account.
Okay.
So that's the second way. The third way is I'm like, hey Kevin, can you write me a check?
Right.
So there we go.
Because you advanced me the $800. If you never get paid, then you've got to have some place to go so you can get repaid. Because remember, this is not an equity investment, this is debt, and the lenders always expect to be repaid. Okay, well that's great. So what about personal guarantees in factoring arrangements?
Sure. So it's so funny because it's always cyclical, right? Right. It depends on how competitive the marketplace is, because that really dictates whether you're going to get a personal guarantee or not. I'm going to tell you right now, here is the biggest secret in lending. Are you ready?
I'm ready.
Okay. No one is ever going to collect on a personal guarantee.
Right.
Right. Just doesn't happen.
They're used to ally interest, right? Personal guarantees, we want, as a lender, we want a personal guarantee because it means if things don't go according to plan, we have an ally. Because we could call the guarantee, but I'm like you. It's been in very rare instances that I've actually seen a personal guarantee lead to a lawsuit that ends in a judgment and an actual check getting cut. Typically, guarantors will try to do the right thing in the best interest of the deal in a collaborative way because they know that there is that ability for them to call on the guarantee. What is your experience similar?
I agree. It is a long and tedious process to collect on a personal guarantee, and by the time you actually get all the way, because you're right, you have to sue somebody, you have to win the judgment, then you have to do an asset search. Let's hope they have assets.
Right.
Let's say their only asset is their home. You can put a lien against their home, but you can't force them to sell it.
Right.
So banks notoriously aren't going to collect on guarantees, but we love them as lenders because, just like you said, that person has skin in the game. When I've got an issue, I'm going to call you up and I'm going to say, Kevin, you've got a personal guarantee. I hope you're sitting on the same side of the table as me as we're working on getting this collected out.
Right.
And that's really what it comes down to. And every lender is going to tell you the absolute underlying reason why they want that personal guarantee is exactly what you said.
Right.
So let's say in lieu of that, you've got somebody who says, I never sign personal guarantees, I refuse to. All right. So one thing, you can walk away from the deal.
Right.
Or you can say, you know what, I really want this deal. I think it's a pretty good deal. What else can we do here? You can do a validity guarantee.
Okay.
So a validity guarantee is not a corporate guarantee, which is a little different. I'll tell you about that. But a validity guarantee is basically it's signed by the controller, an owner, somebody who's basically responsible for reporting. And it just basically says that, they will furnish, valid financial statements, that they're not going to lie. It's got all the bad boy, clauses. You're not going to do any of the bad things. If you do those bad things, then it becomes a personal guarantee.
Right. So it's a bad boy guarantee sometimes.
Yep.
Okay.
Yeah. So, but a lot of times it's so much easier for somebody to sign a validity guarantee.
Right.
Especially if it's a public company, because we have 2 or 3 public companies, and the CEO is like, look, I don't own the company. I'm not going to sign a personal guarantee. And then fine, sign a validity guarantee.
Right.
Promise me you're not going to send me fraudulent invoices or financial statements.
Right. And of course, there are situations where you've got publicly traded companies sometimes, like microcaps in the case of factoring deals, maybe. And then also private equity-backed companies where you're never going to get a guarantee.
They won't do it.
But those are really the only 2 instances where you're never going to get a guarantee. And so you try to get validity guarantees. But in this market right now, or at least I'll say for the last year, it's been pretty hard to get a loan without getting a personal guarantee. But like you said, it sort of moves in conjunction with the market. Right now, because we're post-COVID, and if you're watching this in 2024, we're recording this in May of 2021, so we're just on our way out of COVID. The government is the largest lender in the land, and so there's not as much deal flow today. And so lenders are sometimes more willing to give up on guarantees or do, have alternative springing guarantees, for instance,
Correct.
springing covenants and things like that.
We've done that.
Right. So what about other situations, like, for instance, debtors in possession? So if a company goes into bankruptcy, it's no longer the same company. It's under the jurisdiction
Correct.
of the court. Can factors still work within those types of structures and still provide factoring services?
100%. So you are correct, and I think a lot of people don't understand that either, that when an entity goes into bankruptcy, it is now a separate legal entity.
Right.
So you've got your pre-BK client, and then you've got the post-petition. So pre-petition, post-petition. So we love, as we call them, DIP deals, debtor in possession DIP deals.
Right.
So the reason we love them is you've got a company that just looks like a mess. Like Carrie came in and and she, it's like the movie. There's blood everywhere, right? So
Another Carrie, not my wife.
Not your wife, Carrie, right? So, but it's like just blood splatter everywhere. And once that company files the bank, for BK, now they're a new entity. There's an automatic stay, so no one can be collecting from them. It puts them in a much better cash position.
Right.
And so we can go in as a lender, we get our documents, we have DIP documents that we can get approved by the court. And then we have a super priority in the accounts receivable that we finance.
Right.
So now we're still doing the same things that we did before in terms of we're still validating that those invoices are good. We're still making sure that what we're purchasing is good and we're going to collect. But we are in a super priority. So the IRS can't come in front of us. Lawsuits or can't come in front of us. Nobody else can step in front of us or taint our
Right,
collateral.
just the lawyers and the accountants and those people that they call executive claims, right?
Right. But it's also super cool because you don't have to file a UCC-1 when you're a DIP lender.
Right, it's all done through the court.
Correct. Yeah.
Right.
And the nice thing also that I like about doing DIP deals is everything is super transparent. So they have to, file their monthly financials, and there's really, it's like a microscope on that business. They have to show every dollar that went out, every dollar that came in. So, you've got a client that basically they're showing everything.
Right. So there's a lot of discipline in those kinds of deals. And then there may be an opportunity when they emerge from bankruptcy, assuming that they do emerge from bankruptcy and it's a Chapter 11, maybe a restructure or something, then you might have a much better structured customer on the way out.
Yeah, and we've actually seen a lot, and I don't know if you've heard of the Article 9 sales.
Yeah, I've seen a couple of, I know of a couple of groups that are doing these
Yeah.
sort of outside of bankruptcy
Yeah.
Article 9 restructures.
So we actually just financed a company that did an Article 9, and I'm talking to a client now that probably their best choice is to do an Article 9 sale. So basically that's what the lender would put them into foreclosure, and there'd be a credit bidding process. You'd get a third party that would go buy the assets of the company, so they're free and clear of all the liens, and then we'd go in and we finance the new company, NewCo.
Yeah, I actually used to have to do that working for a mezzanine finance company in my early days. When you're a mezzanine lender, not unlike being a super senior lender like a factor or an ABL lender, you're usually underneath somebody else. So your only way of getting a dollar out of that is to do an Article 9 sale. You basically go in and you own the company. You basically buy the company with a credit bid, and then you fire all the employees and hire the employees and run it for a while until you can sell it and have some kind of liquidity event and hope for the best.
That's a whole nother section for you to talk about.
Yeah, we'll get to that in a future episode. All right, Robyn. Well, we've covered a lot of ground here. I really appreciate you being here again for part 2 of this analysis of lending against accounts receivable, both on factoring and the ABL side. We've covered a lot of ground, but we've got more to cover on part 3. We hope you enjoyed this episode, and we hope we see you again next week for part 3. Thanks a lot.
Thank you.